Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. I'm Robert Kuhn. This is Destination Retirement. Thank you for listening today. This great Saturday. Hopefully everybody's had a great week. A lot to get to this week. Certainly was an interesting week in the market. Seems like that's kind of par for the course these days. I think obviously a complex and evolving retirement planning landscape is making it difficult for consumers to determine which strategies and tools are right for their unique needs. That is one thing that we specialize in. Those individuals who are in retirement or within 10 to 15 years to retirement. Our job is to make sure that we are allowing your portfolio to embrace uncertainty. We incorporate uncertainty in asset allocation construction, which helps us overcome the shortcomings of traditional portfolio models. The easiest way to get in touch with us and to have a conversation is to call Paige. Paige will set a time for us to talk this week. That number is 630-492-1912. 630-492-1912. She can set a time for us to talk this week. The website is backing up, so we're happy about that. We do podcast every episode, so if you like the show or if you caught just a portion of the show and you want to listen to, every show that we've done in the past, certainly can do that. We do podcast every show, so you can go back, I think, almost 2 years now. At KUHNCP.com. So KUHNCP.com. Again, call Paige this week. Let's have a conversation. 630-492-1912. Those individuals who should reach out, I'm often think about that, and I look at who does reach out every week and we have conversations with, and they're all types of investors. And generally, the common theme is they're not 100% certain that their portfolio could withstand this changing market. They're nearing or in retirement, and they are concerned. And they have right to be concerned because most of the portfolios that we look at are pretty basic. They don't have uncertainty planning. They don't have uncertainty strategies. And I think for the next 1 to 3 years, that's going to be at a premium. And I think that's why we get the downloads that we do of the podcast. And also, I think that's why we get, those individuals that call in. And I think if you asked everybody who called in, our job is really just to have a conversation, learn what you're doing, and see if we can help improve your current situation. So a couple of things on rates this week. As you know, if you listen to the show, our philosophy on managing money is kind of a bucket strategy. We want to make sure that we have protected growth or protected income, depending upon your situation. Our equity strategy is all individual securities. The strategies that we use are four. We call them core four. All four rank in the top 5% of all like managers. One is two in the top 1%, and one in top 2%, and the others in the top 5%. So again, this is what you need. You have to have the best of the best. And then lastly, the opportunistic growth strategy. With markets the way they are, we're finding tremendous opportunities to take advantage of near-term pricing dislocations and hopefully really make some significant gains. So the current rates on the protected growth strategies are still 15%. So really simple math. You get the first 15% currently of the S&P 500 on an annual basis. Once you receive a gain, that gain's locked in and never to go down in future down markets. So Obviously, that is a phenomenal, in our opinion, risk reward when you can get 100% principal protection, the first 15% of the upside currently, and then you get that gain. If you get a gain in a year, it's locked in. If you have fixed income and you've lost a lot of money, let's have a conversation. It could be a great fixed income repair strategy. And for those who just want some good growth potential with, safety, it's a great philosophy. On the equity side, really simple. If you have over $100,000 and you're invested in mutual funds are not customizable. They're not tax efficient. They are not, you really just, when you look at kind of what funds are, there's just so many limitations. But when I look at it, the lack of transparency, the lack of customization, and then the lack of, they're just not tax efficient. It's a challenge. So if you have over $100,000 and you are currently invested in ETFs or mutual funds, let's have a conversation. I think you'll be surprised, especially when you find out that the average growth fund is losing 2.1% to taxes. So a lot to get to this week. I want to talk about what a successful retirement looks like and how we get there, the importance of managing volatility in portfolios, the benefits of having exposure to multiple asset classes, and kind of some other things that come to mind. If you listen to the show for any length of time, sometimes we go off topic, but my job is to provide you with something that I believe is educational, and you're going to get some benefit out of it. So the market currently is challenging. We're in kind of this very narrow trading band, which I think is driving many people crazy. The market is, for every good day, there seems to be a bad day. And that is when people start to get itchy. But as we talked about last week, that when everybody is on one side of the consensus, generally the other side happens. And so the consensus going into this year was a first rough part of the year, then a strong back half of the year. And honestly, stocks could have a surprisingly strong first half of the year. The risks of a recession certainly still may loom in the second half, but you have to watch for opportunities in stocks. And I think, we have to be wary of the human tendency to fight kind of the last war. And the famed investor Barton Biggs once warned that you just must be wary of human tendency to fight the last war. And if you think about that, it makes a tremendous amount of sense. And nothing more when it comes to investing is one of the biggest mistakes that I see from individuals and I see from financial advisors is they're always backward looking. When you meet with a new potential client, you want to show them something that looked good. And so what you do, or what most advisors do, is they're going to screen good investments, good mutual funds, good ETFs that did well for the last 1, 3, 5, 7, 10 years. That means very little about what is going to happen going forward. And you have to be concerned about that. Again, the financial advice business, I think there's major conflicts of interest. And we have to look at not what did well, but what is going to do well, or at least what we believe has the best chance to do well. Most investors today are fighting, certainly the last war is the bear market of 2022, and believe that corporate earnings will collapse in early 2023 and bring the stock market down with them. Pessimism is rampant, but I tend to be a little bit more opportunistic if you have the right strategy. That is the challenge. There's a big caveat to that. I love the fact that, I hear a lot of people say, well, most people will sell, people like you, Rob, that I talk with, they're going to sell on fear. Fear. And certainly we're nervous. Certainly we're concerned. Certainly we have to manage risk. But I'm a pessimist. I'm not a pessimist in really any area of my life. I'm much more of an optimist. But I want to make sure that you understand that you have to have the right portfolio. You have to have the right strategy so you can realize, the gains, but also protect from potentially the major losses. So, historical analysis points to a quirk of presidential cycles. We often hear a lot about that, especially with, when Biden was elected and going into, now, the back half of his first term. During the 16 quarters of every presidential cycle since 1950, the S&P 500's best quarter of all 16 is the first quarter of the third year. So obviously if you do the math, that's the quarter we're currently in. And the 12 months following a midterm election, such as 2022, the S&P 500 has averaged a 33% gain, and the index has netted an increase every time. So the current presidential cycle has been, no exception to that pattern thus far. So hopefully pointing to positive potential for, certainly this quarter and next quarter. And it's, a challenge because, if you look at the economy, I mean, there's, parts of the market that are slowing, and then there's certainly parts of the market that are being very resilient. And when you look at economic indicators such as GDP and employment, they're showing that the U.S. economy is proving too resilient to really truly warrant a potential, first quarter collapse in earnings. And that ultimately is what everybody is looking at. And I think the outperformance of financials, industrials, and materials in recent months also suggest otherwise. So you have to make sure. I know so many people are sitting on the sidelines. They're sitting on cash. And, I hear over and over again, I want to wait to put this money in the market until I feel better. And, well, what makes you feel better? Well, the market goes up. Well, you may miss 5%, 10%, 15, 20%. And if that's your philosophy, what that tells me is your portfolio is not constructed correctly. Because, again, we want to make sure that we have that protected money that we know we can't lose, whether it's on the growth or the income side, that we have maximum customization, transparency, tax efficiency on the growth side. And then very few advisors do anything very well on the opportunistic side, which is we want to, own where the money is flowing to. And that may be short term, it may be long term, but that's the money that we're really trying to take advantage of, pricing dislocations. And so what looks, when I look at a successful retirement plan, I don't find many people actually truly have it. Most people don't even have an income maximization plan. And when you look at, people think if you've got, $100,000 to $1 million, well, I find those investors, they're very concerned about their income, rightfully so, right? But the investors that have 2 to 5 to 7 million, they have to be equally as concerned. And I find that their strategies are the most lacking. And so, you have to make sure when you look at planning for a successful retirement that we're not just doom and gloom, but we have protection, we have growth, we have opportunistic growth, and then we have alternatives, right? So when we look at alternative strategies, if you have over $2.1 million net worth exclusive of your house, we have some fantastic strategies in the alternative space. Under 10 million, they're lacking in private equity. Over 10 million, 100 million, a billion, 5 billion, they have a tremendous amount of money in private equity. So, we have to have those strategies. We have to have those conversations. So, our clients are, that $100,000 investor, and that's all they have. And we have clients that have net worths of 25, 30, $40 million. So our job is to, fix and create the puzzle that's going to ultimately provide you with your successful retirement. It doesn't matter what others have, but it's your successful retirement. So give us a call. Let's set a conversation up with Paige, 630-492-1912, 630-492-1912. As much as I am an optimist, I want to go over 3 signs that the bear market isn't over. We'll get to that after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the host of this radio show that you're listening to. I'm also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. We are a fiduciary. We do believe in facts over feelings. We have a data-driven process. We think a data-driven process is the best approach to portfolio construction. We want to make sure that you have protection, principal protection, and income protection alongside the best and top strategies on the growth side. As you know, access to our growth strategies currently rank in the top 5% of all growth strategies. When it comes to dividend growth, top 2%, small and mid, top 1%. Focused growth, top 5, and all cap growth, top 5%. So who should reach out to us? I'm often asked about that. If you're not 100% certain your portfolio could withstand 3, 4, 5, 6, 7 years of what we just went through, we have to have at least a conversation. And those individuals who have over $100,000 of investable assets and you own mutual funds, I still see $500,000, $1 million, $2 million portfolios inside mutual funds, and they're paying a fee to own those mutual funds to the advisor. It doesn't make sense to me. Lack of transparency, lack of customization, lacks of tax efficiency. Average growth fund, it's reported that loses 2.1% a year in tax loss. Think about that. Your return is dragged down by 2.1% a year just due to taxes. So if that's you, let's have a conversation. You can call Paige. Paige is our great assistant. She'll set a time for us to talk this week. You can do that at 630-492-1912, 630-492-1912, and she'll find a time for us to talk. And also, you can visit the website. We do podcast every episode, kuhncp.com, kuhncp.com. So if you heard a little bit of the show, but you want to hear more, just go listen to all of our past shows. So we want to help we want to help those that want help. And our job isn't to try to convince you that you need help. If you don't recognize that you need help, or if you're not 100% certain that your portfolio is, can withstand, the turbulent markets that we think are going to come, more so on the volatility side, not so worried about 2008 scenario. I'm worried about 2000, 2001, and 2, where we see, 3 down years, and it doesn't even have to be significant down years, but subsequent down years or down years in a row, the succession, I think, could be an issue, and that's kind of a concern of ours. So we are optimists, as you know. We talked a little bit about that in the first segment, but we have to also be realist. And there are some signs that the bear market isn't over. It's a challenge, and I think when you look at every investors, they appear optimistic, certainly. But when you look at the U.S. government bonds, gold, and oil, they tell you a less encouraging story. And our job is to be a realist, to be direct, but make sure that when we look at a portfolio, that we have some protection, whether it's growth and income. Those current rates are up to 15%. So principal protected up, and then the growth is up to 15% currently of the S&P 500. Big key there is when you get a gain, that gain's locked in. And when, with the equity bucket, we are overweighting the dividend strategy currently. We think, dividends and free cash flow are at a premium, especially in this market. And then in the opportunistic side, we found tremendous value and opportunity in energy stocks. And they've just absolutely done, phenomenal. So stocks, at the end of last year, they ended the year, fairly strong. And they've continued their rebound into 2023, actually delivering one of the best openings to a calendar year since 2000. Now, you have to look at that, though, and remember what happened in 2000. I mean, the market ended up down. It ended up down in 01, and it ended up down in 02. And so we have to make sure that we are paying attention to the Federal Reserve. I think it's widely expected another quarter-point rate hike is coming, even as the Fed confirmed its commitment to fighting inflation with no rate hikes or rate cuts likely in 2023. Investors look to the S&P 500, and it's currently at its highest level since last August. And the volatility gauge, which we pay a lot of attention to, is at its 52-week low. So many investors, it seems they continue to see a new bull market underway, and I certainly hope that's the case, based on an opportunistic scenario in which the Fed successfully tames inflation with only modest slowing in the economic growth. I mean, the markets are very strong. Corporate earnings and employment. I think it's one of those, good news is bad news or bad news is good news. We're in one of these maddening scenarios where, interest rates are, they did what they did. And I think that's when you look at the protected side of our, portfolio allocation. I mean, I can't remember the last time, if ever, I could look at a client and say, for your protected money, for your bond alternative money, that may be 10% of your portfolio, it may be 50% of your portfolio. We don't know. Clearly, that's individualized, but it's principal protected. And currently, you get the first 15% of the S&P. I mean, think about that for a minute. And then when you get a gain, that gain's locked in. I mean, that's a really strong story, and that story is driven by interest rates and what happened, in the interest rate market last year. And it's one of those kind of anomalies that there are so many people out there that I talk with that they just tell me over and over again, I can't see another cut of 20% to my portfolio or 30% or 40% of my portfolio. And we're talking with individuals who, are with, these big firms, and they feel just like a number because their answer is, whenever they express concern about what's going on in the market and their portfolios and the fact that, they're in their 50s, they're in their 60s, they're in their 70s. And last year, not only were their equities down 15 to 20%, their fixed income was down 15 to 30%. And the answer is, well, just sit and wait, right? Well, that's not a good enough answer. Because if there wasn't options, then that would be the only answer and you'd have to do it. But there are options. And so, those are the conversations that we're having every single day of the week with investors that are just kind of looking at, their portfolio statements and just saying, what gives? Is there a better way? And what I have found is you have two types of individuals, one that just kind of bury their head and they don't want to address it, and they justify it by saying, well, everybody's losing money, which is factually just inaccurate. And that's not a way to look at kind of portfolio management. And then you have those others that, will reach out to advisors like us and they'll say, I'm just not confident in kind of what we're doing. I mean, you have one chance at retirement, right? I mean, that's it. And, when you look at the environment that we're in currently, as, optimistic of a person that I am, we have to be very concerned. We have to be very concerned that we're in potentially a low growth environment. And I want to make sure that your portfolio could still withstand that that type of an environment, that you could still grow, that you could still compound your money, that your income, could still continue to increase potentially, because that retirement red zone is kind of that 10 years pre, 10 years post, retirement. And it's just not good enough to work with an advisory firm or an investment firm that doesn't take a proactive approach to managing money, that just simply, slaps a fee on an account to then farm out to mutual funds. I mean, it's mind-boggling to me. And, the challenge that I have is not so much this year or certainly last year, because I think we've been busier than we ever have been. And that makes sense because a lot of people have lost a lot of money. But it's, in years that are good, is explaining to individuals that, listen, you're making money, but that doesn't mean your portfolio is constructed correctly, because you're just one down market away from giving back all those gains. And then what kind of stress is that going to provide you if you have a down market or a down series of markets over 1 to 3 to 5 years as you get closer to retirement or you are in retirement? So, those are the people that we're talking with. 630-492-1912, 630-492-1912. But again, when you look at, is the bear market over? I mean, obviously nobody knows. If I knew, I certainly wouldn't be doing the radio show. If anybody knew, they certainly wouldn't be giving financial advice because they'd just be off somewhere making every single trade 100% with 100% success rate, and obviously making more money than they know what to do with. But my concern are really threefold when I look at, even though stocks are trading higher, recent market action of other asset classes paints a starkly different picture. And there are three that merit, I think, particular attention, and they're not exciting. They're boring. But that's just the way that it is. We have to, humans, most humans are opportunistic and optimistic. And so they think, well, everything's going to come back. Well, okay, maybe everything comes back. But if you look at what happened with Microsoft in 2000, it took 16 years for Microsoft to come back. So you bought Microsoft in 2000. It took you 16 years to get back to even. We can't have that if you're, I think, ever. But if you're within 10 to 15 years of retirement, or you're in retirement, we can't have that chance of happening. So when we look at what concerns me, what keeps me up at night, U.S. government bonds, I think Treasury yields remain deeply inverted, a time-tested signal that an economic downturn is on the horizon. Yields on shorter dated debt are higher than longer dated debt, which is what they constitute as it being inverted, because generally the longer you give somebody money, which is what a bond is, the more interest rate you're going to receive for that. Well, it's the opposite right now, and that has done a very good job of really just showing that an economic downturn is on the horizon. You look at gold, and since the October low for the S&P 500, gold continues to outperform both the S&P and the NASDAQ. Very curious, given that many investors view gold as a safe haven when turbulence looms. And so, while the price of gold is likely, got a boost from rising rates around the U.S. debt ceiling, it's likely would not be maintaining this level if economic growth were in fact stabilizing or rebounding, as stocks seem to think. So you just look at who's buying gold. I mean, it's shocking the amount of gold that's being bought. And then lastly, we have to look at oil. I love oil stocks. But if equity investors are expecting a soft landing and potentially rebound in economic growth later in 2023, oil prices do not reflect that. When you look at crude oil futures, for example, they're down 8.6% year to date, almost 19% from a year earlier. So the consensus expectation for oil suggests that falling demand in the U.S. could offset any demand gains from a recovery in China. And those are the things that, we remain cautious about the direction of equities, for, this year. And that what we have to really focus on is that we must focus on portfolio construction. It's 100% at a premium. And if your portfolio isn't constructed in three components of growth, protected growth or protected income, growth that doesn't have to stay fully invested, that's transparent, that is tax efficient, and is certainly customizable, and then lastly, if you don't have that opportunistic bucket where you could take advantage of this near-term pricing dislocations and anomalies that exist and continue to exist, we just think that you're not going to be, happy. That buy and hold, that strategy of just set it and forget it, I think you're going to be disappointed. So with that being said, if you want to have a conversation with us this week, give us a call, 630-492-1912, 630-492-1912. Again, we want to embrace uncertainty. We want to incorporate uncertainty planning in our asset allocation, in the portfolio construction. We think that's going to help overcome the shortcomings of traditional portfolio methods. At least that's what we believe to our core. And if you believe that, then we want to have a conversation. So 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Okay, welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are fiduciary. We believe in embracing uncertainty when it comes to portfolio construction. I think it's key that we incorporate uncertainty planning and asset allocation and portfolio construction, which we believe wholeheartedly can help overcome the shortcomings of traditional portfolio methods. It's proven, and we believe in a data-driven, how hard is that to say, data-driven process. We think a data-driven process is the best approach to portfolio construction. If you're not 100% certain that your income, that your portfolio could grow, your income could remain consistent or increase in a year like we had last year and an environment of maybe low growth over the next 1 to 3 to 5 to 7 years, those are the individuals that we're having conversations with. If you don't have written retirement income maximization planning, tax mitigation planning, we want to have a conversation with you. That's all it is. It's a brief conversation to learn a little bit about you and learn a little bit more about what we do and what we provide and what our process is. And if those line up and you like it and we think that we can help you, because ultimately that's our job, then we're going to have take it to the next step and do a portfolio review, do a retirement financial plan and analysis, and then share with you why we think our strategy is going to provide you what you need in a period of market uncertainty. So with that being said, give us a call. You can call Paige at 630-492-1912, 630-492-1912. She'll set a time for us to have a conversation this week. So to close shop on last segment, when we were talking about the, why, potentially, we're getting conflicting indicators as far as the bear market being over and, the market's running. I think, we're all talking about, everybody's talking about, is it going to be a hard landing? Is it going to be a soft landing? I don't necessarily know what either of those mean. I mean, conceptually, yes, but for a soft landing to happen, I think that's held by many investors. For that to be validated, we truly need, at least if you look at history as a gauge, we need to see steeper yield curves, weaker gold prices, and stronger performance in energy. Investors, I think, should focus on income generation, at least at this period of heightened uncertainty. And as this period plays out, we have to continue to focus on short to intermediate term kind of thinking. There's tremendous opportunity in certain asset classes. And, we love talking about, just customization. And I just am so tired of seeing these cookie cutter portfolios for the 100,000, the 500,000, the $1.5 million dollar investor on up that just has mutual funds, and then you're paying an advisor for those funds, and then or just simple ETFs. I mean, it's just I don't think that's going to perform. And again, as we look at, we have to look at what is going to perform, not what has performed. And again, when you adhere to data and you adhere to facts, and you have an approach to looking at the markets and portfolio construction, and if we can build in uncertainty planning, uncertainty strategies, it's just kind of a win-win. And it's not only is it a win-win on the numbers side. I mean, I have to imagine, I'm 48 years old, and so I still have many working years left. I'm not quite sure how I would feel in this economy, in this market, 5 years from retirement, 3 years from retirement, or in retirement, because I think it's just going to be a challenge. And if there's a big if your portfolio is not constructed properly, and I know this because of 25 years in the business, the conversations that I have on a weekly basis with individuals, it's just many people aren't, their portfolios or advisors have kind of only set their portfolios up for a positive market, and I think those are going to be a challenge. I think again we're in this up and down period, and as we talked about, on our protected strategy in the protected growth bucket, I mean, we're seeing strategies out there that allow for 100% principal protection, 15% of the annual gains of the S&P, and those gains are locked in. And again, for so many people who lost money last year in fixed income, that may be a great alternative to kind of recoup those losses. And so, those are things that we want to make sure that we're having conversations with. And again, I think it's just education. You don't know what you don't know. And with any investment, there's kind of a good and a bad, or a pro and a con. And, that's what we have to make sure that we're always explaining, not only the good, but we understand kind of some of the limitations of an investment, because everyone has them. CDs have them. I mean, CDs give you that peace of mind for safety, but they're not even keeping up with inflation. And especially, when you look at after tax, but yet you have that peace of mind. But then down the road, is your money going to grow? Is it going to, are you going to continue to have, the same purchasing power that you have today in the next 5 to 7 years? And so everything has a good and a bad, and we just have to look at and create portfolios that, have more good than limitations, and limitations on the loss side. Those are the things that we want to make sure that we're, challenging, because it's it's a challenge, because people don't understand when you lose a certain amount of money, what ultimately has to come back, what you have to do in returns just to get back to even. And especially if we're in a period where, not every dip is being bought, and we're going to annualize, 15, 16% a year, like many asset classes did over the last 10, it's a challenge. So 630-492-1912, 630-492-1912. So let's get to, when we look at, what happens, after a year of falling assets. Again, 2022 was a challenge. 2023, I was as happy as anybody, I think, to see the calendar turn over. We talked a lot about, what a successful retirement looks like. And I think we've shared this, especially this episode, how we get there. But I want to talk about the importance of managing volatility in retirement portfolios. I think when you look at portfolios and you look at, what I have seen constantly are, balanced portfolios, and you look at, asset classes, and that, when you look at a statement of a client and I ask them kind of, do you think you're diversified? And of course, everybody says yes. And this is, not a surprise, because, generally if you're seeking out, advice and education and help, this isn't something that you do full time. So when we look at diversification and we see that, people think that they're diversified because of the number of positions on in their portfolio, that doesn't mean you're diversified. And that just means that you own a bunch of different things, but those different things could all be, in the same asset classes. And when we look at kind of that $100,000 to $3,000 or $3 million investor, many times they own two things. They own equities and they own bonds. And it's no wonder in years like last year that they have a challenge, and they have, a challenge in trying to overcome and, fight through, down markets. Because I think the job of an advisor is to always pursue better outcomes for clients. And that, if you think about, we often talk a lot about, clarity of purpose, right? I mean, 3 basic words: clarity of purpose. Well, what's your clarity of purpose inside of your portfolio? Most people just don't have a good answer, because the advisor hasn't given them the knowledge, the explanation of here's how the portfolio is constructed. We talked with a listener this week, and they mentioned after, we went through portfolio construction and how we construct a portfolio, and they said, we've never heard it explained this way. And to me, that's just the best thing somebody could say to me, because my job is to educate how you construct a portfolio, because we don't know what's going to happen, when the markets are down. So if we have clarity of purpose in a portfolio, and if our job is to pursue better outcomes for clients, what does that ultimately mean? And well, I think for one, it's really simple, is making sure that clients' safe money is not down 15 to 30% like last year. I mean, the industry is broken. They want to talk about, fees. And you've heard me get on my soapbox over and over again, but fees are really irrelevant. I mean, yes, the only time that they're relevant is if we know that the markets are going to go up forever. Then yes, you want the lowest fee because ultimately you're going to win, right? I mean, it's simple, but that's not reality. That is just simply not reality. And so first and foremost, you have to make sure that your safe money is exactly that, protected against loss, whether it's growth or income. That then frees up mental space for you, the investor, to then really go after some growth assets. Because if you know that your income is met and you know that a bucket of your money can't go down, and like I mentioned earlier, the rate today is up to 15% of the S&P, well then, and that may only be 30% of your portfolio, or 25 or 50. I mean, that's individualized, but that frees you then to not have to stay awake at night when you see statements and you see, just that you're losing a bunch of money. Because I think the great advisors, they're both a bull and a bear at the same time. Unfortunately, in this industry, generally you're only one or the other. You're always selling rose-colored glasses, time in the market, don't worry about it, the world's great. I mean, my goodness, who could say that today? The world is not great. I mean, there is so much risk and there is so much uncertainty that when I started this business, in the late 90s, I haven't seen another period like this. And then you have the flip side to that, where they're just always negative. It doesn't matter what's happening. They just think the world's coming to an end. They think you have to put it in gold. They have to think you have to put it in, annuities that are just, aren't going to grow much, but they give you that peace of mind. And the reality is that the good advisors, the good, firms, the good, educators, like I think that we are, you can be both a bull and a bear at the same time. And that's when you have a good strategy. So if you don't know that and you're not certain of that, we need to have a conversation. Paige will set a time for us to call this week, for us to speak this week. Give us a call, 630-492-1912, 630-492-1912. Again, I think that we have to uncomplicate complex thoughts. And we have to look at a holistic approach that brings relevant, timely insights to every client of ours. And we have clients that are in different stages. We have, I'd say the bulk of our clients are in that kind of 50 to, 80-year-old range. But that doesn't mean that we don't work with individuals that, are younger and still doing well. But it's, investing, if you think about it, it's really simple. And if we can construct a portfolio that could lose less in down markets, then ultimately I think that's the formula for beating the markets over the long term, right? And you have to do that. And it's just something that we're very, very passionate about, because we have to structure for portfolios that are forward looking, not what did well. You come into my office, I don't care about showing you something that did well. If somebody did that to me, I would say, well, what does that mean? It means nothing. I want you to talk to me about the next 1, 3, 5, 7, and 10 years. That's how you know that you're with a proactive, cutting edge type of advisory firm. I think if you're hoping to make money, and if you're hoping that your portfolio could withstand, big drawdowns or significant volatility, or you're hoping that you can recoup all of those losses on your safe money, many times, as hoping is hopeless. And so our planning is focused on helping clients forecast how their portfolios are going to look in the future. And again, you have to know what your margin of safety is. People don't even know what their margin of safety is inside of a portfolio. And it's no wonder that everybody just says, you know what, I don't want to look at my statements this week or this month, or I don't want to log in because I know it's just going to, make me upset. And I get it. I mean, I'm not, we all are human, but that's where we come in. And that's where we want to say, listen, there is a better way. Let's simplify it. strategies are complex, right? But let's simplify it in, compartmentalize it. We got our protected growth and income bucket. We got our growth bucket. We have our our opportunistic bucket, which includes our alternative strategies. And so when we can dive into it in that regard, and then we can look at making sure that your income, whatever those needs are in retirement, that those incomes are going to be met with that big G word, guaranteed. Whether it's Social Security, whether it's a pension, and whether it's CDs, or whether it's, annuities. There's so many different choices of how income can be guaranteed. We have to make sure that that your income needs are met, and then let's free up the rest of the money to really grow. And let's look at it in a way that we just want to make as much as we can with the least amount of risk. So that's it. I know it's kind of a rant, but hopefully you got something out of it. So I will be back with you in a minute. If you do want to have a conversation this week, just give Paige a call, 630-492-1912, 630-492-1912. If you want to listen to this show or past shows, check out the radio page on our website. That's KUHNCP.com, KUHNCP.com.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Okay, welcome back. This is Destination Retirement. I am Robert Kuhn. I'm the host of this show, clearly, and I am also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. We work with clients really kind of coast to coast. I mean, as you know, or maybe you don't know, if this is your first time listening, we have a very diverse set of clients, and we love that. But we don't think that you should be defined by working with somebody, especially in this day and age, just simply by location. Think about that. I mean, it's like, so many people, they want to work with somebody close to them. Well, what if that person's not good? What if those strategies are not cutting edge? What if they're not proactive? What if they're not forward looking? One of the things with Zoom is it really opened up, our ability to talk with people that, aren't just in our general vicinity. So that's one of the reasons that I think the podcast has done so well, is we're, talking with and sharing our beliefs and our passion with so many more investors than we were pre-COVID. And we're really pleased and thankful for that. So 630-492-1912 is the way to get a hold of us. If you want to have a conversation with us this week, call Paige, 630-492-1912. And she will set a time for us to talk this week. So I want to go over this last segment, questions. And it's kind of questions that I would ask somebody. And I want you to think about it. And if you can't answer these questions, or if you need help answering these questions, then, certainly, make it a point to reach out to us this week. But, one of the questions I think is questions in my mind are to get investors thinking and really get to the motivation of, one person may think that they're risk averse or they're super aggressive until the markets do something that, they didn't expect. And then they realize, well, maybe I'm not as conservative, or maybe I'm not as aggressive as I once thought. But what do you value more than money? I mean, the really basic question, right? But, I think this question really shifts the conversation from dollars and cents to really what is truly important in a person's life. And I think the most common response that I get, at least if you asked me that, it would certainly be family, right? But, what are we doing this for? I mean, what are we investing for? Is it for you to spend and maximize every penny and spend every dollar that you have? Or is it to have a good retirement and then ultimately leave a legacy? And when people hear leave a legacy, you can leave a legacy with $1. You don't need $10 million, $15 million, $20 million to leave a legacy. And we're, so proud that, our firm works with clients who have $100,000 and clients who have net worths of, 30, 40, $50 million. We're never going to change that. And just because somebody works with, only you need $500,000, you need $1 million to work with us, that doesn't make them better in any way, shape, or form. I just think that, our passion, as long as I'm running, this firm that has my last name, we're going to help everybody. So what do you value more in money? If you're asking me, certainly my family, my health, and my faith. And so those are the things that I think, it's a really good conversation to have with a friend, a spouse, or just ask yourself that. So another question I found pretty thought-provoking when it comes to thinking about money is, what makes you feel at peace? What makes you feel at peace? I think when you understand stress relievers and a person's motivation, it's a great way to learn potential traits and values. And I really think it provides us and whoever, if you ask yourself that question, an opportunity to uncover any potential concerns or problems that you may think are on the horizon. And so, what makes you feel at peace? Is it income? Is it portfolio balance? Is it knowing you can't lose money? Is it trying to, take your assets and 10x them? I mean, everybody's different, but what makes you feel at peace? And so really give, that some thought. A couple other ones I have before the end of the show, but I know this is a little different segment, but I think it's important because it gets you thinking. It gets you thinking about kind of life. It gets you thinking about money. And then ultimately it gets you thinking about your current portfolio and if you're truly satisfied with it. And if you're not, certainly we'd love to see if we could help you out at 630-492-1912. Paige would set some time for us to talk this week. But you have a stress-free, total-free Saturday and Sunday. What do you do during that time? Is it, something that you try to spend, looking at your portfolio? Is it, you try to, look at, the advisor and what they're recommending? Or do you spend time with your family, your friends, and kind of just, just don't think about a lot of what's going on in the world today? But I think that can give you an idea of kind of, how strong or how secure you are with your current investment portfolio. One that I love that I've been asked, and I really wrote it down when someone asked me it, was, what has your attention in the world today? I mean, that to me is an open-ended question that allows, I think, certainly myself to, when I was asked that question, to express the most pressing financial issues generally, or geopolitical issues, or family issues that we're dealing with. And, to me, that's just a something that we really have to think about, because it all relates back to, we manage money. So I'm going to relate this all back to money and portfolios and retirement, because I'm often asked, do I have enough? I don't know. I mean, I don't know if you have enough. I mean, I have, a client that it has, is down to their last $10 million. And they said, I just don't want to lose it. And it's like, okay. I mean, you tell that to, some of my other clients, and they would say, my gosh, I mean, I have $100,000 and you're telling me that, you have 10 million and you don't feel like enough. I have 100,000 and I think it's plenty. So, wealth is truly individualized, but we're seeing in this industry, most of the big banks, most of the big brokerage firms, they're going after the higher to ultra high net worth client. I mean, it's, and I think everybody needs help, but when you look at what they're doing, kind of the forgotten people are kind of the 2 million and under client. And, these bigger firms and these bigger banks and certainly the brokerage firms, I mean, they want you to have $3, $4, $5, $6, $7, $8 million. And certainly they're going to still work with you. Generally, I mean, I've heard of some firms at $500,000 and under, limiting or the pay that you get in your revenue share with the big firms. But I don't know if that's still the case. But it's, we think everybody needs help. And, I know the 1 million and under client is underserviced. I know most of their strategies are not proactive. I mean, it just is my belief because of what I see. That $1 to $3 to $1 to $5 million client, I know that they think that they have the most proactive, cutting edge risk managed tools, but it's just not there. And it's, and I think a lot of people had that realization last year. And my question to you is, what did you do about it? I mean, what have you done about it? And if you have done nothing about it, then, maybe it's time to do something about it, because we're going to see it again. And we could see it in consecutive years. May not be this year, but, what would happen if we saw 2 or 3, years of negative market growth in a row? Or we don't, instead of averaging 6, 7, 8, 9%, what if we average 2, 3, 4%? What does that do? So, and lastly, well, we don't have any time to get to the rest, but hopefully, you found something that we talked about this week that struck a nerve, or you found, something you want to dive deeper into. A couple ways to do that. Certainly go to kuhncp.com. That's kuhncp.com. You can listen to all of our past radio shows. We do podcast every show. So, make sure that you listen there. My ask for you is, if you do listen to it and you find that it is of interest to you, pass it on, text it to a friend, text it to a family member. Let them hear the story as well, because we're passionate about getting that message out. And if you want to take that next step and kind of bounce some ideas off of me, or ask questions, to me about your current situation, we'd love to have that opportunity as well. And so you can call Paige at 630-492-1912, 630-492-1912. And she'll set a time that works for both of us to have a conversation this week. So with that being said, hope everybody has a safe week. Hope everybody has a profitable week. And we'll certainly be back next week with more information. Take care.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.